everyone, and welcome to, well, for us here in the UK, this evening's session. And somebody has just said they are in Bangkok. So good morning, Lars. Thank you so much for joining us. I hope it's not too early where you are. David and I have been to Thailand, but not for many, many years. And hopefully we'll be able to visit again sometime in the future. Before we start the session, can I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Now, those of you who were here a week or so ago will know we did try and run this session, but we had all sorts of problems with our internet, and in fact we had to abandon the session because there were latency issues. And what it turned out was we were trying to run it on the system on Wi-Fi, and it just wasn't working. But we're now back on the Ethernet. We're hardwired, so hopefully it should all be okay. I know David can hear me. Can you hear me, darling? Are you okay? Yeah, I know he can hear me. I am assuming that you can hear me. All of you can hear me as well, but if you could just put into the chat box, yes, I can hear you loud and clear, that would be fantastic. Thank you, Lars. Well, you can certainly hear me in Bangkok. So brilliant. Thank you, Malcolm. Thank you, thank you, thank you. Right. In a way, I'm glad we didn't do the session the last time around, because today's been almost the perfect day to have there's been a lot going on across all the markets. It started off in the Forex, and we have now ended with the FOMC minutes. Actually, if I just bring up the calendar for today, you can see not very on Forex Factory. It doesn't look very long, but it's really packed a punch. For the Forex, obviously we had the rate decision in New Zealand from the RBNZ. We had the CPI numbers, the inflation numbers here in the UK, and they are truly eye-watering. Although those of you who've been coming along to our sessions regularly will know David and I have been saying this since last year, that central banks should be careful for what they wish for, because they have certainly unleashed the inflation tiger. What's also interesting, it's one of the comments made in the FOMC minutes was that inflation will diminish once demand goes down. Well, given that inflation is primarily caused by energy costs and food, David and I were sort of wondering, well, maybe if we stop eating and don't drive and, suffer from hypothermia, the demand will go down. But facetiousness aside, it really is a very serious business. Not that you would think so from how the market has been behaving recently. And if you're scratching your heads, let me assure you, you are not the only one. And we're going to talk a little bit about that, and also look at the indices and a couple of stocks in particular. We're looking at some particular patterns. We're going to drill down and look at some elements of volume price analysis. But just to return to the calendar, we had the inflation here in the UK. We've had the retail sales in the States, which are neither one thing nor another. And of course, we've had the FOMC minutes, which I've just picked up on my Twitter feed, and the sort of immediate reaction from experts on the Fed. They basically managed to sound both hawkish and dovish, and the markets decided that, all right, we're going to be dovish, and so everything has a reverse. Let's see, the NASDAQ has come back a little bit. You can see there from the candle, and the Dow, which is the US 30, that was minus, I think it was down 156 or something, is now down only 16. But what's very interesting that we can see here is the VIX. The VIX is now below 20, and the VIX is one of these instruments that is really that determines whether the market is fearful people say greedy. I like to use the word complacent. Complacency means that participants, traders and investors think, the good times are going to carry on. And what we do with the VIX is we basically look at the levels. Now, obviously, it's still in double figures. It's when it starts to get down to these figures here, then the market becomes overly complacent. It's at a market top, and it works inversely. So, for example, the lower the VIX goes, this is the volatility index for the S&P 500, the higher the S&P 500 will be moving. And when things become, there's the fear Armageddon, financial Armageddon is coming, as we can see here, it will spike really, really higher. And in a way, it's to be successful as a trader or investor, you also have to have an element of be a contrarian, and you will hear people like Buffett say, the time to buy is when there's blood on the streets. Basically, everyone is so frightened. That's the time to buy, because obviously everything has crashed, everything is now cheaper. And the time to sell is when everyone is so complacent, they think, this markets are going to carry on to the moon. And there's also an element of what they call FOMO, a fear of missing out. So these rallies get underway and more people pile in, and they try and push the price higher and higher. But if you've read my book on volume price analysis, you will know, you will read the signs in the price action and the volume, and in the volume patterns that you see in the different phases of price action, of what we call at a top, which is the distribution, and a bottom, which is where we have accumulation. And we have accumulation when the market has had a massive, a big fall. There's been terrible fear, but it's possibly time to reverse. So that's a sort of very general intro into what's been going on today, and as I said, it's just been an extraordinary day because it's impacted all the variety of instruments and a variety of markets. And the great thing about volume price analysis is that you can apply to all of them, and you can apply them to all time frames. And in a way, David and I always say, we have a chart, we pull it up. If you took away the ticker and you didn't even know what it was, and you just looked at the price action and volume, you could make an analysis on that, and obviously, if it's a stock, you've got other factors that you have to consider. You would have to put it in the context of what index it is, what sector it's in. You have to build out, if you like, the narrative for that particular stock. But from a purely chart analysis perspective, price action and volume, as I said, you don't even need to know what the ticker is when you're doing that analysis. We're going to structure this session because we'd like to cover, as I said, the markets in in as much as possible. But we are going to start with the Forex. I'm going to actually be focused on the MT4 platform, which I have here. I'm going to use it in two different ways. I'm going to start with the Forex. David's also got Forex. He's got, you're going to be doing Tradingview. David's got Tradingview. And then once we've had a quick look at Forex, as I said, we've had a lot of news for Forex today, then we're going to move into the indices, and I'm going to do some stocks, and I'll be looking at, and both of us will be looking at NinjaTrader, but I'll also be looking at the MT4 platform, because what I have here at the moment, it's called the US 2000, which is the MT4 platform's version of the Russell 2000, and it's been a really, really interesting chart, because the Russell 2000 is the small cap. Its constituents are all the small cap, 2,000 small cap companies in the US. So risky. I think they're capped at something 1.5 billion. and it's just been going great guns. And this index doesn't really perform unless there is confidence, there is money, there's money flowing into risky assets. And as I said, given the background with rising inflation, we have a war, we have shortages, we have climate problems, etc., etc. You think, well, what on earth is happening? And it's one of these, as I said, this confusion at the moment, as we have a fundamental landscape, we have releases which put the fear of God into everyone. And what does the market do? The market is carrying on high, but we'll talk a little bit about that in the second part of this session. To return to the Forex market, the last point I'd like to make on the stock side to do with Forex is, even if you are your prime interest is in stocks and the indices, we still think you should pay attention to what is happening in the Forex market and to that currency that is of the country that you are investing or trading. So, for example, here in the UK, our primary index is the FTSE 100. It doesn't actually reflect the sort of economy, or most of it's only 100 stocks, the companies that are in the UK economy. But if you understand that the FTSE 100 is primarily made up of energy stocks and commodities, you have to know what the dollar is doing, because dollars are commodities are quoted in dollars. For the US, for example, the dollar strength that we have been seeing has had an impact on those companies that are exporters, that derive a large percentage of their earnings abroad, and that is going to have a problem. And in fact, one of the companies I was going to talk about later is Cisco. I'm waiting for them to report, and because I did a very long post about them back in May, the last time they reported, and there was a big gap down, a huge gap down. They're a massive company. Their stock is only about $46, which is totally at variance with the size and of the company, the market cap of the company, and also the dividend they pay. And one of the reasons why they gapped down so badly is they had underestimated the cost of a strong dollar was going to have on their profits. You would think a company like that would have actually paid for some hedging. They haven't, and I think it's going to cost them something like $6 billion. So we're not talking chump change here. So if as a trader or as an investor in US stocks, always try and find out and establish, when you do your background check and risk assessment of the stock that you're interested in, as well, is it going to be impacted by dramatic currency fluctuations? Doesn't always. The US economy is unique in the sense that it's a very self-contained economy. There are thousands of companies that really never export. Their market is the US because it's such a huge market. But there are companies such as Apple, such as Cisco, such as Facebook. They are big companies, and the importance and the reason I say this is those companies also make up, they have very large weighting in the indices. So when they have a problem, if they have a problem with the exchange rate, that's also going to impact the indices. And if you're a futures trader, you want to know that as well. So it kind of squares the circle, as it were. We talk about this a lot in, we will be talking about it a lot in our upcoming stock program. What we're trying to do in the stock program is bring together all these elements that we believe traders and investors need to understand, not just the chart analysis, which is volume price analysis, but all the other elements that will take your analysis to another level, as it were, beyond simply the technical one. Right, what's been happening with the Forex? As always, we start with, well, what's the dollar has been doing. It kind of peaked. It's been on a bit of a downward slide. You kind of would have expected that because the equities have been rising. A weaker dollar does favor, if the dollar weakens, then stocks tend to. It's one of these relationships, not always. And then when there's a bit of a pullback or there's fear comes into the market, it is the safe haven. It's one of the ultimate safe havens. So it's had a bit of a reversal. Some really nice volume price analysis lesson, if you like, you've got here. It just caught my eye immediately. This was the reversal. You've got two up candles. That one's of a wider range than that one. What do we have? We actually have falling volume. Well, that's that little signal there on its own. It tells you that isn't going to go very far. And with volume price analysis, it's price action and volume, but it's also support and resistance. And we have price-based support and resistance from the Camarilla pivots, but also the volume point of control. And where does it stop? It stopped at the VPOC. Now, what's interesting is yesterday it posted this sort of smallish, like a little shooting star. A shooting star is a candle with a tall wick to the top of the body. It's always going to be at the top of a run. If it's in the middle of a trend, if it's in the middle of a downtrend, such as here, for example, you can't call that a shooting star. It's simply a weak candle, and the expectation is that the price is going to carry on lower. It's a lot of volume underneath it. That sort of that fell, but it's then you've got to see the context of the price action and volume. Also, is it contained within important, significant levels of support and resistance? As I said, these are pivots. Fibonacci acts as in exactly the same way. So if it's around a key level, the 50%, the 38 point whatever it is, 61, then those levels will also impact what is also happening with the price action and the volume. And around the volume point of control, what the volume point of control does, it also gives you what we call these bands, and you have this histogram. And when the price action is in these regions, what we call high volume nodes, where the histogram moves over to the left of the chart, that is also, you have a density of volume there, and that will also have an effect on the price action. It tends to sort of smother it a little bit, whereas where you have a low volume node, as we see here, where the histogram is narrower, there you will find that when the price approaches that, it will go through more quickly because there isn't so much of that dense volume. It's like thick cloud, this volume to actually sort of prevent it and cushion it, as it were. So that was just a little thing on the dollar and what's been happening with the dollar. Then we've got the CSI, where we've got the individual currencies, and we can see here this is the Kiwi, as I said, the RBNZ, where basically the commodity currencies, they also act as kind of sentiment bellwethers. So if the Aussie is selling, the Kiwi is selling, and we'd like to see the CAD selling, the Canadian dollar selling as well, that also can give you a clue as to what the market sentiment is, and that is positive for equities. So yesterday, or rather overnight, the Kiwi dollar, it had the RBNZ as a central bank. It did increase the interest rates to 3%, I think 3.5%, whatever it was. So it was as expected, as it were. The press conference and statement was kind of, a little bit hawkish. Yeah, they all central banks are being very macho at the moment because they're all determined to say, yeah, we're going to slay the inflation dragon. So we're going to do whatever it takes to do that. But the market kind of it didn't really. It kind of said, yeah, fine, but it didn't strengthen as much as you would have expected that. But that is partly because it also has this this relationship with sentiment. So it's a kind of balance between the two. If the RBNZ has said, yeah, we're raising interest rate and they're going up 2%, then yeah, absolutely, because they will be so out of whack with the other central banks. That would take them to, I think, something like 5%. They haven't been 5% for years. And traders and investors are then going to buy the Kiwi because for the interest rate differential. It used to be called the old-fashioned carry trade. So interpreting news, interpreting what central banks say, there is what is expected. If the bank does what is expected and there's no major surprise, you get a bit of volatility, but it kind of carries on in the direction that it was doing. It really has to be something quite dramatic for it to change course, as it were. As regards the British pound, again, the same applies. The data was so awful, but the bank has been as macho as all the rest. Yeah, we're going to do whatever, and it's what that whatever is. If it's just going to be another 50 basis points, 25 basis point, yeah, that's awfully interesting. Interpretation of fundamental news is an art. Trading is an art, but that is even more of an art, because not only do you have to learn to interpret the numbers, which is actually fairly straightforward, and no, you don't have to be an economist to do that. It's what the market thinks, how the market is going to react and what actually happens on the chart. And generally with fundamental news in the Forex market, it's almost, we've found from experience, is wait for the first knee-jerk reaction. You're going to get loads of traps. You will see the traps. VPA will highlight the traps, and you wait until that's died down, and then you can move in. Now, if you're in a trade already, depending, if you are in, I don't know, the hourly chart, the 4-hour chart, the daily chart, do you close out before a major announcement? And this is very much a matter of personal decisions. David and I have been in trades when it's been NFP. I mean, think of all the important releases, and we say no, because whatever volatility is going to occur, you're in a longer time frame, and you just accept it, and you look at the longer term charts, and if they're not at a point where they are likely to reverse, a strong reversal point, then we say, yeah, we'll see. And sometimes it actually goes in our favor. So it's you've had a bit of a boost from that release, but there is no hard and fast rule about it. The nice thing about what's setting up on the CSI, this is on the hourly, is we want to see these strong divergences. We want to see some overbought, some oversold, because we know on the faster time frames we are going to see some reversals. Most traders trade the faster time frames, and what the CSI does, it just picks them out and say, this is where you perhaps are going to find a trade. The other currency to consider is the Japanese yen. Now, the Japanese yen is one where it's sold off when markets are taking on more risk, they're more risk tolerant, and it's bought when markets are risk averse. That too has had its own kind of little quirks lately, but it just generally fit that pattern. So this selling off, the dollar selling off, the market has taken from the FOMC and from the retail sales. Yeah, we know what's going on in the background, but we're going to carry on higher. And what's interesting, it's not just the indices, but it's the growth stocks, as we've seen in the US 2000, and the tech sector. They're kind of behaving as if we are moving out of a recession and not into a recession. And this, as I said, has kind of caused a bit of head scratching, but as I said, I'll revisit that when we look at indices and stocks more closely. There is an atelier in these currencies, and that is the Swiss franc. The Swiss franc is a safe haven currency. It behaves, investors will move into it. because it's safe haven, but that is moving higher. It's kind of flattening off a little bit. What we really want to see, if it's, you know, if it's this, the sentiment is rippling through all the currencies that we would expect. You would expect to see the dollar falling, the Swiss franc falling, and the yen falling. When you have those three together, all going in the same direction, that's a stronger signal. That's what I'm trying to say. But it's all a little bit, you know, it's a little bit up and down at the moment. And it's August and it's summer, so there's a degree of seasonality. Volumes tend to fall. They not fall. There's just not. There are not so many participants. Liquidity is not as deep as you would say expect in, I don't know, September, October, for example. But still, all that being factored in, as a trader, you just trade what you see on the chart. Now, as regards the charts, there is an indicator that we've been meaning to focus on for some time, and we've not done so, and we're promising to do it, and this is the heat map. And the reason why I wanted to focus on the yen is because we developed this indicator because we wanted to see what was happening in multiple time frames with our currency pairs. And the way this works, the currency heat map on the certainly on the MT4, is obviously you have all the time frames for the MT4 across here. Now, these values that you see here are actually the values that are taken from the matrix. But then what the algorithm does for the indicator, it then weights these values according to sentiment. So what it tells us is, of the yen pairs, and it's quite useful actually, because the yen pairs, because the yen is the counterparty currency, they all, you know, they're easy to spot. Whereas if you look at something like the Kiwi, you have to kind of think, because the Kiwi here, it's the counterparty, but here it's the main currency. So you kind of think, well, are they buying the Kiwi, or are they selling it? You do get used to it, but being able to spot it quickly for the yen. And it's very interesting because with the yen pairs climbing on the currency heat map, what this tells you is that the yen is still heavily sold. And we know that because we look at the monthly values, and you can see they are, you know, I won't go into how they're calculated, but as I said, what these values are telling us is that we're not seeing a major reversal in the yen pairs. When, you know what I said, the yen acts as both safe haven and risk currency, because the yen pairs are sort of resolutely stuck at the top of the heat map. This is also kind of confirming the general market mood, if you like, which at the moment is still positive, despite everything that we read about and what is going on in the world. The pairs, the yen pairs, these pairs will change position. A couple of weeks ago when we were here, the euro yen, the euro actually was selling off quite heavily, so that kind of had a bit of a reversal. But they're all, as I said, they're all at the top of the heat map. And if we look at the values at the bottom of the heat map, we can see, you know, these could kind of be, I wouldn't say the same, but if that's 14, you would expect that to be minus 14, minus 1500. It's not. So it also tells us the kind of strength of flows that are going into these pairs. Now, so that gives you a snapshot, or a global snapshot of, you know, market sentiment, what, you know, which pairs are strong on a weighting basis. And you can use this indicator for major, and this is really major reversals, but you have to accept that they stay overbought or oversold for some considerable time. So the way to look at whether you are reaching a point of a major turn is you really have to consider the longer term charts, and which is great if you don't have time to sit in front of your desk and you want to spend, you want to put a trade on and maybe not forget about it, but don't have to watch your monitor on a minute by minute basis. And an indicator like this will help you do that. But you will have to then consider certainly the monthly, the weekly, and the daily charts. But you can also use this indicator, on the faster timeframes, because these cells are picking the values up from the matrix. You can see the kind of reversals, and whilst the say the Aussie yen or the New Zealand yen is been in an uptrend, those pullbacks and reversals are perfectly tradable on the shorter time frame. So it kind of tells you, yeah, you are going to be able to trade it, but you're probably not going to be in it very long, because markets are still very, very positive. They will certainly move much more around a release, such as a central bank interest rate decision. If it's the dollar, it will be the NFP. Whatever piece of fundamental news the market is fixated on it, because it reflects the current either business or economic cycle. Those of you who come along regularly will know, before all this inflation thing kicked off, no one was really interested in not interested in the CPI, but it didn't have a huge impact because they couldn't get the inflation rate, allegedly, over 2%. No matter what they did, as it were. So it has a more muted impact. Fundamental releases, really, you read them in exactly the same way as you read a chart, and you place them in the context of an economic or a business cycle. At the moment, employment is a classic one. Employment, there've been full employment in inverted commas, well, certainly since before the pandemic, and it fell off a cliff, obviously, when the whole world shut down. At the moment, we have good numbers coming out, and whilst the NFP numbers, they're now being taken as evidence that the economy seems to be holding up. What I would say about economic indicators and releases is that they fall into three camps. They are either leading, lagging, or coincident. Lagging is obvious, and employment is a classic lagging one. Sometimes it takes like 9 months before the true picture emerges. And a leading one would be something like a sentiment indicator. I think the one that a lot of analysts like to use, it's the small business one. It's really those indicators that tell you what is going on at the coalface, what is going on with the companies that are feeling the most effect from interest rate rises. Are consumer sentiment, are people truly spending? Are they worried? That it tells you what is happening in the here and now. Those are leading. And coincident, well, they kind of give you a picture of, it's not leading, it's what's happening in the now. But a leading one is, as I said, those people who kind of do the nuts and bolts, who are creating the wealth in an economy. So that's what you do with the heat map. David's going to show you the one on Tradingview, which is a little bit different, and it's got some very, very interesting features. But just to have a quick look, I haven't looked at these any of these pairs in detail, but let's have a look at something like the New Zealand yen. Let's have a look. What do we say? Let's have a look. Okie doke. So what do we have here? Well, we have the New Zealand yen certainly on the daily chart. We've actually got it in. It's almost like in a sort of well, it's around the volume point of control. It's in a very, very wide range, as we can see here. Some very big, wide-ranging candles telling us that there would have been trading opportunities on the faster time frames. But let's see what is happening on the. Now, this is interesting on the monthly chart. Now, you know, I said. You know, pairs can stay overbought or oversold. What this is telling us quite clearly, I mean, this is over 1, 2, 3, 4. This is 6 months. So this is how long sometimes you have to wait for a major reversal. If I just scroll it back here, this is back to January 2020. You can get what we call these V-shaped reversals. We had this big candle, massive. I'm missing the volume underneath it. I think there's a problem with my feed there. But just the candle on its own would tell you with that depth of wick, you know, it's only going to go in the chart. It will go in one direction. How far it goes, well, it depends on the subsequent candles. And the nice thing about this little pattern here, this little volume pattern here, is we have the wick, and then we have the rising volume, and up it goes. It then falls away. It falls away here. This is what I'm saying. This is the kind of anomalies that you have to look for. Doesn't mean it's going to reverse. Just because the volume falls away, it simply means you are going to get a pullback. And what you then need to see is, well, what is the volume going to be on the pullback? What's interesting about the Kiwi, then it kind of carries on really, you would call that below average volume. But again, as long as it's consistent, yeah, and it gets to the volume point of control, it's, you know, we do like to see these, as I said, these anomalies, but markets can go up and they just sort of, they can drift up. They don't fall. We haven't had it. We don't have a month here where it actually closes. It closes in red, and then we go into a sort of extended period of congestion. But the interesting point about the New Zealand yen is the number of months where we have candles with wicks to the top of the candle. Now, eventually they will come down. That, you know, it tries to rise, it falls. It tries to rise, it falls. Now, obviously on the monthly chart, this is going to take ages and ages and ages. But at least with the heat map that we saw here, let's bring it up. This is what it's saying. Yes, it's still staying up there, but you just have to consider what the individual candles are actually telling you. And in a way, you apply the same, you know, I'm using this as if, you know, I'm going to be in this trade for however long month. There are, you know, there are banks and there are institutions that will stay in these trades for months and months. The only thing I would say is the cost of carry. And that's always determined by the interest rate differential, and different brokers may apply different costs to that. So whilst you might see a fantastic trading opportunity on a longer term time frame, and you think, yeah, I'm really going to be happy to sit in this trade for the next, you know, X weeks and X months, you have to watch what that costs you. And to give you an example, I've you know, been in trades, and, you know, fortunately they've gone in my direction, but the carry has been, you know, quite high, and, you know, and against me, it can be positive for you, but when it's against you, you have to consider that as well. And obviously the bigger contract sizes, the more that's going to cost you. Whereas in a trade in the equivalent NASDAQ that you can trade on my an MT4 platform, I think I was in a trade for like 2 weeks or so, and it cost me $1.57, which is nothing. It's absolutely peanuts. But you have to check with your broker. Okay, right. I'm going to stop there, and I'm going to pass over to David. As I said, he's got something to say on the on Forex. And what we're going to do with this session is that we will divide this video into two, and I'll upload them onto YouTube. As I said, the first half will be Forex, and the second half will be stocks and indices.
Hi everybody, and a very warm welcome from me. Hopefully you can hear me loud and clear as well. Just looking at Anna for confirmation. You can, brilliant, okay, lovely, thank you. Just move that out the way and just drop that away out there. Where to start? In fact, let me just start with the Anna mentioned the currency heat map, and in particular the currency heat map with regard to Tradingview. This is only available on Tradingview. It's just one of those unique quirks of fate that allows us to construct the heat map in this way on this platform, which is we can't do on any of the other platforms, unfortunately, much as we would like to. And the major difference is if you look at these two heat maps and you've got our indicators and you're familiar with our indicators, you'll know that on NinjaTrader and on TradeStation and on MT45, you are restricted to the timeframes that we set for each heat map, which is not the case on Tradingview. With Tradingview, as you can see here, I've actually got two different ones here. This is on 1 minute, 5, 15, 30 and an hour. And over on the right-hand side, I've got the much slower 1 30-minute, hour, 4-hour daily and the weekly. And you can have as many of these running, and you can set them to whatever time frames you wish. The principles of the way they work are exactly the same in that the ranking ladder here on the left-hand side, the 28 pairs, the way they are ranked by weight. And by that, I mean the weight of the time frame here. Now, it doesn't matter that we're looking at faster time frames. The weighting aspect will still work in exactly the same way. So the currency, the time frame that will carry the greatest weight is the hourly, and the time frame that will carry the minimum weight is the 1 minute, which is what you would expect. I mean, that's logical that if you're seeing a change on a 1 minute time frame, then it shouldn't have as much significance as if you're seeing a change on an hourly time frame. Now, while Anna was talking for the last 30, 35 minutes, what happened following the FOMC was that I've isolated this out on the dollar. As you can see, we've only got the dollar pairs here. What was actually happening here, we had all the dollar pairs, or certainly the euro, the Aussie, the pound, and New Zealand with the dollar as the counter currency, all stacked up at the top here. And then we had the dollar Swiss, the dollar yen, and the dollar CAD. They were all down at the bottom here, which is what you would expect, because if the dollar is either being bought or sold universally, that's what you expect to see. And now what we're starting to see is all of that unravel. Excuse me, you're starting to see it in terms of what's going on in terms of the sells. So you've got some bearish sentiment on the 1 minute, you've got that rolling through into now bearish sentiment on the 5 minute, you've got the same occurring for the Aussie dollar. Now, that sentiment, if that bearish sentiment is going to continue and roll through into the 15 and ultimately the 30, what will then happen, it will then move these down dramatically down the ranking ladder, because a 15 minute will carry more weight than a 5 minute, and a 30 minute will carry more weight than a 15 minute. And that's really how the currency heat map works. So the beauty of it is on the Tradingview platform, you have literally, you can choose anything you like. It's very simple. You just go into the settings down here, and you can just select whatever time frame you want. So whatever time frame is available up here on Tradingview, you can just select it down here. And obviously you've got the filter section. I've got this filtered on the dollar at the moment, and you've got various other things you can change as well. So it's a very, very flexible indicator. We would love to do it on the other platforms as well to have that functionality, but we can't for the reasons I've explained. It's just not available as an option. It was just a happy coincidence that you know, that is what actually occurred. Now let me just flick over onto Ninja. In fact, I've got the multiple CSIs up here. When the FOMC announcement came out, what did we see? We saw the dollar selling off very strongly. That was counterbalanced by very strong buying in the Japanese yen and equivalent buying in the Swiss franc. That started to slow down, but what's interesting is now the dollar buying has also, if you like, joined forces with the yen and the Swiss franc, which is generally what you would expect to see. Not always, but typically, if risk is being bought or sold, then those are the three currencies that you're obviously going to look at. If we go and look at the charts themselves, the currency, the space that I always use for this kind of analysis, if you like, is my currency majors matrix, because the beauty of it is you get this wonderful, in these inverted patterns, as I call them. So clearly we've got cable here. You know, this is moving this direction when the dollar is sold, and now in this direction when the dollar is being bought. But on the dollar CAD and the dollar Swiss, you get the inverse. Why do I like it? It's because you get a mirror image, if you like. You get a mirror image of everything. You get a mirror image of volume. You get a mirror image of where a VPOC is. For example, on dollar CAD here, you know, the dollar CAD is now recovering all those losses of earlier on, and is now approaching the volume point of control. This is on the 5-minute chart. Obviously, you'd have to look across at all the various time frames. But just from a single time frame, looking at multiple currencies, it gives you a whole raft of information. You've got the trend monitor down here. You've got the volume point of control. Are we coming up to the VPOC? Yes, we are. What have we got in terms of heavy resistance? We've got technical resistance on the accumulation distribution indicator here as well, sitting immediately above that. You've got all that information, but you're looking at it from an inverse perspective. So when you're looking at, for example, cable, where you've got the opposite view, nice 2-bar reversal, you know, what did we see at the announcement of this recent news? Huge injection of volume, massive volatility. It's what I say massive. If you move that out of the way, it's not that big. For such an important announcement, I mean, this has only gone, what, 40 pips, 45 pips? It's hardly dramatic stuff. It looks dramatic on the chart, but in terms of the actual physical movement, it's not a great, it's not a huge endorsement of one side of the argument or the other. It's not saying risk on, risk off. It's just saying, well, yeah, fine, okay. And now it's coming off again. So it's very, very lukewarm in terms of how it's responded to that announcement, to the announcement that, you know, maybe interest rates aren't going to go up quite as far as they thought they might. So it reflects that sort of weakness. That it's a very wishy-washy response, and you can see it here. But in terms of the volume, you get this massive injection of volume. We get a volatility candle. What are we expecting with the volatility candle? We're expecting congestion or potentially a reversal. We get a further injection of volume, another volatility candle, no great surprise. Then the volume starts to fall away and fall away quite dramatically. And this candle, you know, is trying to rise on half the volume that we saw before, which is not anomalous, but it's certainly, it's a trap. You know, you're seeing the volume fall away dramatically. We then get the rally. Okay, we're going up on what should be better volume. We get this candle at the top here. The volume is no greater than the previous candle, and yet we've got quite a widespread candle here. And if you compare it with, I appreciate this one's got a wick on it. I'm just looking at the chart for something equivalent. These have all got wicks. I don't know. You're looking for comparative. You're constantly looking for benchmarks. You're looking for, you know, I'm looking for a candle like this in order to be able to arrive at a judgment call on the volume associated with it in terms of, is this a trap? Is this genuine? Is it in agreement? Is it in disagreement? It doesn't look right. It doesn't look great. We've got a widespread candle, but the volume's not huge. We then get the opposite of this, which is a perfect 2-bar reversal, if you like. If you overlay this one on top, what have you got? Well, you've got a very narrow body and a big upper wick to the upside of the candle, which is a classic shooting star candle. You get 2-bar reversals over the place. You know, they're not guarantees, but they are pretty strong signals. We had a nice one here. You can pick them off all over the place. This is pretty much a classic one. You know, it's almost perfect in construction. Overlaying one candle on another is very simple when you've got two. It's much more difficult when you've got 3 or 4 candles in a bunch. You try and put them together. And that's why we use multiple time frames, because that's the information it gives you. You can't do it in your head. You can do 2 candles in your head, but you certainly can't do 3, 4, 5, 6 candles in your head. That's why you need multiple time frames, because it gives you that information. So we've gone through there. We've got the 2-bar reversal, and now we've come all the way back down. So basically, this is like it's like a souffle, if you like. It's a souffle, what we often refer to as a souffle effect. It's risen, and now it's just gone, oh, do you know what? You know, I'm not too sure about all this. And it's no great surprise to see, given what is going on in the market at the moment. So this is the workspace that I use a lot when I'm purely focused on one currency. In this case, it's the dollar, but you could use this for the yen. You could be euro focused. You could be Canadian dollar focused. It doesn't matter. You just set up a physical matrix like this, and obviously you have the currency matrix indicator itself, which really replicates this in terms of an indicator and gives you all the information very quickly without you having to set up the workspace. This is the manual version, if you like, but if you want the automated version, to put it that way, then you're looking at the currency matrix, which I haven't got set up at the moment, but you know, I'm sure you understand the principles of it. You can see the dollar rising here very strongly, which is nice. So it's climbing, 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 and it's joining the Swiss franc and the Japanese yen, which is what you expect to see. Very quickly, I'm just going to go back on to Tradingview. Let me have a look at, right, Anna mentioned Bitcoin, and I've had this running as well. And there's 2 things I really wanted to point out with this, or several things actually. First of all, you've got the cryptocurrency strength indicator, which we developed, I think last year, or maybe the year before, which has been hugely successful. It's very different in the way that it presents the data in terms of the fact that cryptocurrencies move en masse. Now, unlike the currency world where currencies will move individually, in the cryptocurrency world, they do not generally, 99 times out of 100. And even if there is divergence in one cryptocurrency with the mass, it will almost relatively quickly rejoin its brothers and sisters and move in the same direction. So the nice thing with it is that if you're trading one cryptocurrency, you'll see them all moving in the same direction. The red line here is Tether. It's basically the dollar, if you like. And what's interesting at the moment, for several reasons, first of all, what we're seeing replicated in the currency world, if you like, is being replicated here in the cryptocurrency world, which I find slightly ironic for obvious reasons. So we've got, you know, the Tether rising here because the dollar is rising. So it mirrors that particular performance of what is happening in the currency world. In terms of trading the cryptocurrencies, you don't have to worry about divergence. You're looking for confirmation that they're all traveling in the same direction, which they do en masse here. So it just gives you further confidence, if you like, if you're trading short or long. And the other thing which also is interesting, and maybe I don't think a lot of cryptocurrency traders appreciate it, but you know, this is the volume that occurred at the announcement of the FOMC. So again, not only have you got the relationship with Tether here and the dollar tying the 2 markets together, but you also see them tied together in the context of news releases. So I think it's just one of those fascinating things that cryptocurrencies were developed to actually get away from the currency world and central banks and everything else. But ironically, the 2 are almost inextricably entwined. And I just find it quite curious and quite odd that, you know, that's the case. That is the fact. You can see it replicated here. This was the volume that came in. You saw the huge surge in volume on the currency charts. You've got exactly the same performance that you're seeing coming in on the cryptocurrency market, and it works in exactly the same way. We've got volume, we've got the indicators on here, Got a really nice price waterfall here, rising volume, falling price, just confirming the move for us. Again, we've got a lovely 2-bar reversal here on these 2 candles, put one over the other, and you've got a nice shooting star candle. So really giving you some nice confidence on that one. Down we come, and now we're moving into, we've got a volatility trigger on here. So what are we expecting? We're expecting at the least congestion, which is what we're seeing, so we're not surprised, and a possible reversal depending on what goes on in terms of volume down here. And this is the cryptocurrency strength indicator on multiple timeframes, used exactly the same way as you would do the currency strength indicator. So this is on 2-minute, on 5-minute, and 10-minute. That's just a cable, again, replicated. This is another workspace I use a great deal, and if you have the indications, I would suggest you do the same. These are basically the 4 currency indices. So on the left of the chart here, I've got the pound. On the right here, I've got the yen. On the bottom left here, I've got the dollar, and on the bottom right here, I've got the euro. Euro is not doing a great deal at the moment. This is the buying we're seeing coming into the dollar. Pound is starting to sell off, but these are the interesting one. These 2 here, the diagonal opposites. This is the yen, which is continuing to be bought, and this is the dollar, which is continuing to recover from that initial surge lower. And that's why you're seeing the currency pairs, or certainly the majors at any rate, behaving the way they are at the moment. This is basically the VIX, which again you always have up. And again, what is the VIX telling you? The VIX is telling you about sentiment. I've got it on 1, 3, 5, and 10 here at the moment. And again, I've got some of the indicators on some and not on others, but you can see we've got volatility triggers here on the 10-minute. If the VIX is falling, then equity markets will be rising, and if the VIX is rising, then equity markets will be falling. And the VIX pretty much started off at 20, I think, when the FOMC announcement came out. So it's pretty much recovered to where it is. So I don't even need to look at an index chart, an index futures chart to know what's going on, because I can tell it straight away from the VIX. Let me see just what else we have up here. Right, that was that was the pound. So that's basically on there. Let's just go back and see what's happening on the currency majors. This is our majors matrix. And as I say, it's just a great way to get a view on one particular currency. Well, this could be, as I say, this could be yen, so you could have pound yen, euro yen, Swiss yen, whatever. It will just give you an inverse view. And when the markets are really moving quickly, you get a fantastic view of the volume profiles. You see, if you're seeing buying coming in on the majors, on cable, for example, then you will see selling coming in terms of dollar CAD. And as I mentioned, as we were before, here's the VPOC. What are we expecting to happen at the VPOC? You are expecting congestion. Why? Because it is the heaviest concentration of volume that sits at that particular level. In addition to that, we've got a very strong level of resistance above. We've got a very strong platform of support in below. And this is one of the beauties when you're using the VPOC with the accumulation distribution indicator. You get these fantastic channels. You get the VPOC at the center of it, which is the core, if you like, and then above and below, because price has been oscillating around that price area for a long time, you get this lovely corridor of price action, which is very well defined by the accumulation distribution indicator, which, remember, it paints a visual picture. This level up here is very weak. Why is it weak? Because it's thin, it's narrow. These levels here are very strong. Why are they strong? Because they're thicker lines. That's what the indicator does. So this is a weak level, this is a weak level. These two are very strong because they've been tested repeatedly and therefore create this very strong channel. Once the market starts to break away from the VPOC, you've either got a very strong level of support in place here, or you've got a very strong level of resistance in here if it breaks the downside. So again, using the two indicators in combination like that is extremely powerful. Can I hand back to you, Dan? Oh, right. Okay, I'm just going to pass back to Anna. Bear with me a moment.